FATCA is actually a new piece of U.S. legislation that's aimed at identifying U.S. persons that are putting their assets offshore, either through by opening accounts at foreign financial institutions or through setting up corporations offshore. The purpose is to make sure that those persons are actually disclosing and paying the required tax in the U.S. What the law is going to do is require foreign financial institutions, and that includes banks, broker-dealers, insurance companies, funds, to enter into agreements with the U.S. Treasury by which they're going to agree to identify and report any U.S. clients that they have. If they do not enter into this agreement, then they will become subject to a punitive 30% withholding tax on all payments of what are called what are called withholdable payments. And that's generally going to be payments from U.S. sources, both income as well as the proceeds from the sale of securities. So the law is phased in over a period of time. The law itself becomes effective on January 1st, 2013. And it requires these foreign financial institutions to actually enter into agreements with the U.S. Treasury between January 1st, 2013 and June 30th of 2013. The agreements themselves will become effective on July 1st of 2013. And that is the point in time where the foreign financial institutions will need to start looking at their pre-existing accounts, the accounts they have today, for purposes of identifying whether or not they have any U.S. clients. And that generally goes on for a period of 2 years. They have 2 years to do that, and it is how much time they have is focused on the size of the account and the type of the account. They also, starting on July 1st of 2013, have to have put in new procedures for purposes of identifying a U.S. person when they come in and open up a new account. Any U.S. people that are identified will be reportable to the U.S. government starting in 2014. And that first reporting session happens in September of 2014. The intention isn't to keep people from investing offshore. It's just to make sure that they're filing their taxes. So there is nothing, it's not illegal or prohibited from a U.S. person to have accounts offshore, whether through a corporation or just directly with a bank, as long as they are reporting and disclosing any income that they have from those accounts. So it really just is a way of enforcing compliance with current U.S. tax rules. It's, first of all, not changing the tax law. U.S. people always had a responsibility to file and pay taxes in the United States. Generally what happens is the person doesn't get taxed double. If the income that they're earning is being taxed in another jurisdiction, they will usually get a credit for the amount that they pay there. So if they're in a jurisdiction where they're actually paying taxes at a higher rate than the U.S., they would pay nothing in the U.S. If they're in a jurisdiction where, they either don't pay taxes or they're paying taxes at a lower rate, then they would be required to pay the differential to the United States. So, what's going to happen going forward is that when an entity is dealing with someone else, they're going to want to make sure that they're FATCA compliant. Because if not, there could be a withholding responsibility there. So, for example, I use the example of a bank, a foreign bank. That foreign bank, is going to now want to be careful that when it does something like a swap or a repo or something like that with another financial institution or even a corporation, that it is dealing with somebody that is FATCA compliant. Because otherwise there could be a withholding tax that would be required, which of course then impacts the actual return from any investment. I think what's interesting here is we're starting to see a lot of movement towards government authorities, starting to have discussions with the U.S. about entering into these intergovernmental agreements. It started out with originally 5 countries talking with the IRS. My understanding is that it's up in excess of 40 different countries now that are having these discussions. I think that at the end of the day, most countries look at this as in terms of, what benefit could there be to them as well. And so on the basis of these intergovernmental agreements, they'll be passing information to the U.S. The U.S. will be passing information back to them as well. So a lot of the governments are now looking at this thinking, well, maybe at the end of the day, this isn't such a terrible regime. Maybe it can be beneficial if it also allows us to collect information about our taxpayers. It isn't changing the taxation. That's the one thing to remember here. A U.S. person, is taxable on their worldwide income. That has been the case. FATCA does not change that. It just is making sure that these U.S. people are in compliance.